Learning Objective 5-4, make calculations and prepare consolidation entries for the consolidation of a partially owned subsidiary when there's a complex positive differential and, this is the new wrinkle, other comprehensive income. So let's talk about how we would do this kind of consolidation here in the event that we had other comprehensive income. And you got to remember what other comprehensive income is. Other comprehensive income is kind of like a shoebox. And this is where you put items temporarily until something else happens. So we have the category of comprehensive income. Comprehensive income is income plus other comprehensive income items. Net income plus other comprehensive income items. And other comprehensive income items are kind of like they're weird items where they temporarily go into this account, accumulated other comprehensive income in stockholders' equity. And that's kind of like the shoebox. And then when they come out of it, they go back through other comprehensive income again and then into net income. So examples of other comprehensive income items include investments available for sale and certain hedge transactions and certain foreign currency transactions also. And what happens in all these situations, for example, unrecognized gains on available for sale securities. Unrecognized gains, in other words, these would be increase or decrease in market value of available for sale securities that have not yet been sold. So what would happen is that these gains and losses on increase and decrease in value would go through other comprehensive income into the account accumulated OCI on the balance sheet. And they would just sit there. And if the value of the stock goes up, available for sale securities goes up, then the gain would go into accumulated OCI. If it goes down, then the loss would go into accumulated OCI. And then when you finally sell the security, you would take out all the gains and losses that you put into accumulated OCI, and you would put them into net income as a recognized gain. And that's how accumulated OCI works. The question here is, how do you account for that in a consolidation? Now, companies have a statement of comprehensive income, which should include a reconciliation of other comprehensive income. And we need to know, how do you handle other comprehensive income when it's in a subsidiary that's not fully controlled, 100% controlled by a parent? We have the same information as before, but we're at the end of the second year of the same problem. But Special Foods, the subsidiary, had some purchased call options. And these call options had been on the books for $20,000 and they increased in value. And they're classified as a cash flow hedge. Now, we haven't talked about cash flow hedges yet, but what I can tell you is that cash flow hedges are one of those things that if they increase in value, they go to OCI, and if they decrease in value, they go to the gains and loss go to OCI until the gain or loss is finally realized. And we will be going over this in a future chapter. So purchase call options are accounted for a lot like available for sale securities. And we'll learn more about how exactly it works in a later chapter. For now, let's just know that the value of the purchase call option is an asset and it increased in value from $20,000 to $30,000. And that unrealized gain is going to go to OCI. So Special Foods booked a $10,000 unrealized gain, which is going to go to their other comprehensive income. What Peerless is going to do is Peerless is going to record their share of that OCI as an increase in the book value of their investment, because it's kind of like income. So under the equity method, if you had income, Peerless would record its share of that income as an increase in the investment account. We've seen that before. Other comprehensive income will be treated the same way under the equity method. So in this case, Peerless owns 80% of Special Foods, as you know. So Peerless will increase the investment value, their investment in Special Foods, by 80% of $10,000 or $8,000. The credit is not to income from Special Foods, it's other comprehensive income from Special Foods. It needs to be classified separately. And here you can see the whole consolidation, and you're going to have the whole thing worked up here in a little spreadsheet. So you can see here we have income from Special Foods of $55,200. At the way bottom in the other comprehensive income statement over here, you can see is an unrealized gain on cash flow hedge of $10,000. And that's also going to be important for what we're going to do. So the first thing to do here is our large elimination entry. And I'm going to debit consolidated income for $75,000 times 80%. I'm going to debit non-controlling interest in net income for $75,000 times 20%. I'm going to debit retained earnings for $120,000. I'm going to credit dividends for $40,000. And I'm going to debit common stock for $200,000. So this is just like we did before. I'm going to make this small so you can see everything that I'm doing. And make it all yellow. And then 80% of this will be credited to the investment accounts. That'd be 60 plus 15 plus 120 minus 40 plus 200 times 80% would be $284,000. And the credit would go to non-controlling interest for 20% of the same thing. So that'd be 60 plus 15 plus 120 minus 40 plus 200 times 20%, or $71,000. And if you're lucky, then debits equal credits. There you go. Next thing to do now is focus on the income statement, and we had the additional $6,000 in depreciation. I'm not going to link it because we pretty much know what's going on with that and where that came from. So I'm going to debit depreciation for the $6,000, and then I'm going to credit income from special foods for 80% of that. And I'm going to credit the non-controlling interest in net income, $6,000 times 20%, or $1,200. Next, so that does my income statement now, and you see controlling interest in net income, controlling interest in net income is $215,200, so that balances. Next thing to do is to focus on the write-ups in my balance sheet. And again, I'm just going to type these in so I don't have to waste your time looking everything up. If you remember, the buildings and equipment had a $60,000 write-up, and then I had accumulated depreciation on this. It's going to be now 2 years worth of accumulated depreciation, or $12,000. And I've also got land here of $10,000. And I've got goodwill of $93.75. So those are the various write-ups in the balance sheet. And 80% of this is going to be credited to the investment account. And notice it doesn't balance out yet because I'm going to have to count for the $8,000 debit that I did before. And 20% of this is going to be credited to the non-controlling interest. $13,475 I get. Then I've got my accumulated depreciation entry of $300,000. And I've got to eliminate the double counting of this OCI, because what happened here is that the sub recorded $10,000 gain, and the parent recorded an $8,000 gain. In fact, what's going to happen is this OCI is going to flow through to OCI of the parent. And it needs to be recorded that way. So what I'm going to do, everything's falling off my desk. What I'm going to do here is I'm going to debit OCI from special foods to eliminate this double counting. And then I'm going to debit OCI to the non-controlling interest, the non-controlling interest share of this, of $2,000 to this account. Because of the $10,000, $8,000 belongs to the parent and $2,000 belongs to the sub. So I'm going to credit non-controlling interest in net assets of special foods for the $2,000 OCI that belongs to the sub, the non-controlling interest, and I'm going to credit this portion of it to the investment account for $8,000. So in a way, you really have two pieces of this entry here. You have a debit to OCI from special foods and a credit to the investment account of $8,000. That, in essence, reverses what we did before. And then you're going to have a debit to this account, OCI to the non-controlling interest, and then the corresponding credit will go to non-controlling interest in the net assets of special foods right there for $2,000. One other thing I should note, that in the mechanics of the spreadsheet, that the total accumulated OCI, this is going to flow through to the balance sheet very much the way retained earnings flows through to the balance sheet from the statement of retained earnings. So if you remember, this row here flowed down to here, like so. And that's how I structured my spreadsheet. Similarly, accumulated OCI at the end is an item on the balance sheet as part of other equity, and therefore this row here is going to flow up to here. And you can see here, assets equals liabilities. Check all your work very carefully. Make sure debits and credits are equal. So that's how you handle other comprehensive income. In essence, other comprehensive income of the sub, the parent's portion of that is going to flow through to the parent's other comprehensive income. The non-controlling interest share of it is going to go straight to non-controlling interest on the balance sheet.